Bank of Australia left interest rates on hold yesterday at 4.75%. It was a move widely anticipated by the market. But what about the outlook for the rest of the year? What does the future hold for interest rates? Well, to answer that and much more, Todd from FIIG Securities in Sydney joins me now. Mark, great to have you on board.
Hi, James. How are you?
Good, thanks. Look, as mentioned, market very much consensus we were going to see rates on hold. That is certainly what happened, though we are seeing predictions of rates to increase throughout the year. Firstly, why? And secondly, where do you see them going?
I think the expectation from the traders in the market is that the pressure on the GDP and inflation will force rates up in the second half of the year. I'm not as confident that's going to happen. I think the RBA thinks it's got its policy settings correct. And so if you read over the last, Governor Stevens has been out a lot in the media. It's pretty consistent with his message. He's saying that we see the improvement coming through, but they think inflation will be moderated. They see enough demand in the market to say that they'll be able to keep interest rates pretty much where they are at the moment. So we're slightly going against what the market's expecting.
Mark, do you think one of the keys is that the RBA, Mr. Stevens, as you say, in quite a few appearances that he's made, says that they are looking through the potential inflation implications from some of the natural disasters we've seen and looking more at that underlying, that core level?
Yeah, absolutely. I mean, I think they've got to discount that. It'd be, it's a pretty good RBA that we've got at the moment. So I think they show enough initiative to say that they can see an outlying number and then treat it as a one-off. So I think, it's very hard to work out how this effect of the floods will be, how it's going to be treated. But I think it's important to say that what's the underlying rate movement. So are wages going up and are they going up in a more permanent manner? There's a lot of drivers in this market at the moment that says, inflation, can stay within the band. Retail sales is a classic example.
Well, that was my next question. What do you think it is that the RBA will be looking at in terms of justifying staying on hold, not increasing?
Well, I think they're going to focus, and they've indicated that they are looking at is the consumer behaviour. I think the consumers are looking to save a lot more, and I think they're really focused on that driver of the consumer at the moment. I see the capital growth, I see the corporate activity, but it's very important to see what the consumer's doing and how they react to it.
Do you think there's a little bit of confusion among consumers, particularly, I suppose, when you look at what the OCR level is, but then when you start seeing some of the banks moving, beyond that, and in some cases quite a way beyond it?
Yeah, I think there's a range of messages that the consumer are getting at the moment that make it very confusing, and you could look at, let's look at a short cycle. Let's look at CBA in November, lift the rates higher than what the cash rate was. They reaffirmed it in their half year, which is in February, saying that was a good decision. They're very happy with that, the result of that. And now we're in March and we're in a price war on mortgages, CBA and the NAB, and trying to drag in the other four majors. If I'm a consumer, that's a confusing message, that where are mortgage rates going when I looked at the pointers, the headlines yesterday with rates going up at the end of the year. We're not seeing much growth in the mortgage market, and I think consumers are looking to step out of it and leave it alone until they need the money.
Do you think I suppose that confusion and quite often turning to anger towards the bank when they do see these hikes above the official cash rate has led to, I suppose, the pressure on the government to look at increasing or improving competition within that space? I mean, we had a Senate bank inquiry about it.
Yeah, I think you've got to think of the government as they're in action all the time. I don't think you should think of it as a one-off. So they had the banking inquiry, they had a response to it in December, and they promoted the fifth pillar. They opened up bank accounts in building societies and credit unions, and that's the jawboning effect. Now they're looking to try and legislate around that effect, and I don't think they'll want to stop. I think they look at this competition is amongst the four majors. I think the fifth pillar, as we call it, the building societies, credit unions, are in effect something like collateral damage. And I don't think the government will like that. I think they'll look to say, I want a more expansive banking sector rather than cannibalisation for a short-term gain and then finding out, having won the consumer, we're going to lift the rates on them again. I don't think the government wants to see that.
No, I'd agree with you on that one. Look, Mark, always good to talk. Thanks a lot.
Pleasure.